I'm Jim Cramer, and welcome to my world.
You need to get in the game.
Firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
I always like to say there's a bull market somewhere, and I promise
Mad money. You can't afford to miss it.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you some money. My job is not just to teach, but to coach you how to play this. So call me at 1-800-743-CNBC. You've heard the chatter. So have I. What's that chatter? That we're putting in a top right here, right now. Because given the weak employment numbers, the slowly growing economy, and the lack of any positive growth turn in Europe or China, we can't possibly improve on the earnings we already have. To me, it's the reason why, even as we bumped up against those old earlier highs again, we can't seem to take them out. We can't seem to leave them convincingly in the rearview mirror. The Dow gaining just 10 points, the S&P inching up 0.21%, NASDAQ advancing 0.32%. Look, I get this. I get the arguments. Talked about it this morning on Squawk on the Street. Heard it all day. You know what's known as top-down analysis at work. And I got to tell you something. That top-down analysis, it's suspect. It has to do with the relation between the economy and the stock market, with the assumption being that what really matters to your stocks is whether the economies of the world accelerate or decelerate. That kind of thesis, it can make some sense. It's not fatuous. If economies around the globe are slowing down, as is the case in Europe and China, or showing little growth in jobs or in goods and services sold, as is the case in this country, it does stand to reason that profits could be peaking or could have peaked already and are going down from here. So therefore, stock markets should go down as well, right? It's some sort of cause and effect, chicken and egg, whatever you want to call it. Problem is, the fact that it stands to reason doesn't mean much in the real world of money management. It may seem ludicrous to you, but even if it's true that profits are peaking, and I actually don't believe they are, you can't just assume that stock markets must be peaking too. It doesn't work that way, people. Things just don't correlate like that. It's all theoretical, that stuff. It's all shoehorning. It's Econ 101 into stocks. And that's lazy thinking at its best and a complete irrelevance at its worst. So let me explain. First, as I've said a zillion times, and I'll keep repeating until everyone gets it, we are investing in stocks, not economies. If you were to tell me, Jim, I have a security that trades 1 for 1 with the gross domestic product of the country, I would be all ears. But that security it is not the S&P 500, which trades only in part as a function of profits and is often buffeted by unforeseeable events that can trump those macro concerns. Second, even if you're relating the earnings component of stock ownership to our own GDP, and you find the earnings trajectory waning, how about the other component of owning so many stocks, the dividend yield? Yes, it might be possible the profits are peaking, but tomorrow the Federal Reserve is going to talk about what it will do to stimulate the economy. And I'm sure at some point we will hear that part of Ben Bernanke's plan will be to keep interest rates low, not just for 2013 and 2014, but perhaps even, I heard this chatter, 2015. That means 3 more years of making no more than 1% or maybe 1.5% on your CDs, just lousy, and even less for that money fund you're hiding in. Meanwhile, we know hundreds of relatively safe stocks with terrific balance sheets that yield north of 3, 4, 5%. And if you don't own them, think about it. You might now be missing out on 3 years of that kind of terrific income. 3 years. Further, there are the mechanics of the money management business to focus on. As having been a money manager, I think I can live this and tell you how it works. Do you know that only 10% of the money managers out there, both hedge funds and mutual funds, are actually beating the S&P 500, meaning their performance is in excess of how the S&P 500 is doing? 10%. That is incredibly low. Yet beating the S&P is exactly why you pay an investment manager to handle your portfolio, isn't it? If you can't get that additional performance from an actively managed fund beyond the S&P 500, well, then why not just own an index fund? And the 90% of managers out there who are lagging the benchmark, they recognize that their clients are asking themselves precisely these very questions, and they want answers before the end of the year. So what are these managers who are falling behind the 90%, what are they going to do? You need to know, as a former hedge fund manager, I found it almost impossible to catch up to the averages if I were behind by holding a ton of cash when so many other managers are out there trying to play catch up to the averages every day. Those guys won't hang back. They can't wait for a downturn in the market, or they have to buy every dip in order to make that performance so they can beat the averages. That means even if the theory that links global economics with corporate profits does hold some water, the theory that links those profits to the stock prices might not. Because there are so many money managers out there who feel like they have to chase stocks higher in order to beat the averages, in order to be able to keep the assets under management they have. It's their lifeblood. They're playing for dinner, people. But there's something even more important at work that could derail this economic linkage to your portfolio, and this is a huge point. You should be managing a portfolio of stocks and not simply be at the mercy of all 500 stocks in some index fund. As much as very smart people have said on air, and they say it over and over again, that you can't manage your money, so just give it up to the index funds of the world, I have seen the opposite. I have seen time and time again that individuals doing homework can beat index funds that by nature include good stocks with bad ones. Those who argue otherwise are selling you short. They're presuming you are a doofus. I think you're smart. I know you can do this. Along these lines, you can choose to own the sectors of the S&P that I think will report more robust earnings next year than this one. I'm talking about sectors like anything related to housing and mortgages, anything connected with new product cycles for technology, or anything having to do with non-economically sensitive businesses that could benefit from a stronger euro and a weaker dollar than expected. And before you say, wait a second, Jim, how about that fiscal cliff? The fiscal cliff, that could derail the fiscal cliff, the fiscal cliff. Hey, the fiscal cliff is coming. I mean, oh! Allow me to point out that housing's been down so long it can bounce back from pure household formation, which doesn't stop because of a fiscal cliff. The technology cycles trump Washington spending cycles, and the soft goods sold overseas aren't going to be wrecked by domestic spending issues. For example, and why don't we just take a look at the largest holdings of my charitable trust, which you can follow along at actionalertsplus.com, so you get real stock life examples here, so I can show you what I mean. First largest position is CVS. It's Charlie Victor Sam, okay, not CBS, and it's the pharmacy chain. This less economically sensitive retailer, there we go, is taking it to its biggest competitor, Walgreens, because of a fight that Walgreens got into with Express Scripts, the huge pharmacy benefit manager. A fight that, while settled, has left millions of customers departing permanently for CVS. I think they're going to have a better year next year because of those customers. Next is Apple. All right, what can I say other than Apple had a product announcement today, a new phone cycle that I believe will drive the company's earnings next year regardless of the economic circumstances. Hey, listen, the phone company subsidized the thing anyway. And that's how meaningful the iPhone is to Apple's bottom line, 70%. 7% of the profits. Others must believe that too, as it surged 10 points into the close of today's trading. Third, JP Morgan. Frankly, given the turn in the mortgage business over here and the lack of losses over there, and you better believe Jamie Dimon's going to cut the losses over there, I'd be hard-pressed to believe that JPM's 2013 won't be better than 2012. And then there's Boeing. Okay, sure, there. Hey, I plead guilty. Fiscal cliff. Fiscal cliff. The company was saying it. The McInerney CEO was saying it. It can impact Boeing's military business. But Boeing has finally, at long last, gotten the kinks out of its new jumbo jet, the Dreamliner. And this is the mother of all product cycles. Do you know that aerospace cycles average 7 years in length? And we're just going into the first profitable year of the new aircraft. I will bet on a product cycle over a fiscal cliff. Finally, there's Schlumberger. That's the largest and best oil service company on Earth. Oil looks like it's in a permanently higher plane. I don't see it going down, especially with the unsettled situation in the Middle East. That means national oil companies and independents alike will be stepping up their global spending for oil exploration and development, particularly offshore. No company can make more money from that cycle than Schlumberger. So when you examine your stocks tonight, put them through the prism of economics and ask yourself, do the companies have enough going for them that they won't be hostage if the peaking profit scenario actually does play out? Here's the bottom line. I don't believe that the world's economies are going to wreak havoc on stocks because the linkage isn't really there. But you can do a lot to ensure that it doesn't matter by investing in stocks which offer some immunity to the vicissitudes of a global business slowdown. Let's go to Dominic in California. Dominic.
Booyah, Jim.
Booyah, Chief.
Hey, I was wondering what you thought about the company EA with Apple promising console-quality gaming with the iPhone 5 today.
You know, I heard that, and a lot of people said, listen, I got to buy some EA. That's going to move the needle. Listen, EA is a function of analog hard games going into digital, and you just don't make the money in digital, and therefore EA, while cheap, should not be bought because of the Apple announcement. It should be bought because you believe in the games and play them on digital and like them because the profitability is being impaired by that transition. Let's go to Jude in my home state of New Jersey. Jude.
Hi, Jim. How are you?
Real good, Jude. How about you?
Oh, great. I have a simple question for you. When MGM goes public, will that make them more competitive against Disney and the other companies in Hollywood?
It depends on I'm not sure about. I mean, I only know MGM Resorts. I don't know the MGM movies. I don't know what the price tag would be. I've got to tell you, this is very difficult to compare when a company that's not public against companies that are public. So I can't do it. Let's go to John in Illinois, please. John. Go ahead, John.
All right. Booyah, Cramer. How are we doing?
Booyah, partner. What's up?
All right. Year to date, Navistar is down about 35%. Would this be a good buy considering all the controversy that's going on between Carl Icahn and Navistar about new management?
I am very torn on this because my friend Herb Greenberg, friend and colleague, has written numerous red flag articles about Navistar and its technology problem and its balance sheet problems. But I've also made a lot of money recommending stocks with Carl Icahn, say. So what do I have to say? I say, don't buy. Don't buy. Caught in the middle, crossfire, battleground. I step away. Not going to opine Navistar. Too hard. Mike in New York. Mike.
Booyah, Mr. Cramer.
Booyah.
I know you always suggest making gold part of your portfolio.
Indeed.
September is usually a good month to do it.
Right.
But with gold up already this month and the last couple of months, and the expectations of easing by the Fed and China and the EU already sort of baked in, and there's still no inflation expectations. My question is, do the recent weaknesses in the markets in China and India make this a good time to short gold?
No, I don't want to short gold. Why? Because it's hard to find. We had Franklin Novato on last night. They talk about it. There's not enough money out there trying to be able to find gold. We got a problem in limited supply. We have strong demand. We have China and Indian demand. And most important, if Europe decides to devalue the euro, you've got a currency that people want, and that currency is the GLD, gold. The profits are there. The global economy cannot hold them down forever. Look for stocks that are immune to the global economy and pick them and stick with them. Mad Money, be right back.